Indian stock market has performed quite well in 2023. The Nifty 50 has provided a return of approximately 20% this year, reaching a record high of 21,593 points. It is noteworthy that the market has been consistently delivering positive returns for the past 8 years. This means that investors have received positive returns every year for the last 8 years. What is even more important is that the Midcap index could end this year with returns of around 50%. In other words, Midcap stocks have performed almost 2.5 times better than the Nifty 50 index. So, are there any Midcap stocks still available in the market that have strong fundamentals and are reasonably priced after the rapid growth the market has seen in 2023? Let's find out. After this year's strong and robust growth, experts are suggesting investing in large cap stocks, that is, well-established shares rather than small and volatile stocks, since large cap offer more safety. However, someone like Deepa from Bareilly wants to invest only in mid-cap stocks. If we talk about the Nifty Midcap 100 index, there are approximately 19 stocks out of the total 100 that are trading at a price of below Rs 200. Now, among these 19 stocks, 8 stocks have a significant debt burden, mainly due to a debt-to-equity ratio being higher than 1. However, most of these stocks are from the banking and financial sectors where the debt-to-equity ratio is generally high. The only concerning situation here is the debt position of Ashok Leyland and Vodafone Idea. When considering the selection of a good stock or evaluating a stock based on fundamentals, one often looks at the promoter's shareholding. The market regulator SEBI allows promoters and promoter groups to hold a maximum of 75% of a company's shares. Private companies are required to achieve a minimum public shareholding of 25% within 3 years of listing. On the other hand, government companies have a time frame of 5 years to achieve the same. In companies where the promoter's shareholding is higher, investors tend to have more confidence. This is because having more than 50% shareholding, that is, a majority stake, gives promoters the authority to make decisions related to the company's operations. Majority ownership assists promoters in making significant and crucial decisions. Even after considering this criterion, there are 9 companies where the promoter's shareholding is 65% or more. Among them, the government company IRFC has the highest promoter shareholding at 86.36%. Now, while evaluating the valuation of these companies, SAIL or Steel Authorities India Limited, Indus Towers, NHPC, IRFC and RVNL not only have high promoter shareholdings but also have a price to earning or a PE ratio below 25, making them relatively inexpensive. Similarly, Bank of India, Union Bank, AB Capital and L&T Finance, being finance sector companies, have price to book value multiple below 2. Now, the biggest question for Deepa is which of these companies should be included in her portfolio. Stock market expert Santosh Kumar Singh believes that amongst these stocks, NHPC, RVNL, Indus Towers and NMDC are potential buy candidates. On the other hand, investments may be considered in L&T Finance and IDFC First Bank in anticipation of a decline. From a perspective of 6 to 12 months, he sets a target of Rs 80 for NHPC, Rs 230 for RVNL and Rs 280 for NMDC. Conversely, investments could be made with targets of Rs 180 for L&T Finance and Rs 120 for IDFC First Bank in case of a decline. Although the mid-cap index has outperformed the market on a large scale this year, there are still several good and inexpensive stocks within the mid-cap index universe that are trading below a 200 rupee price point. Considering a horizon of 6 to 12 months, buying these stocks could be a strategy with the expectation of good returns.